Welcome to all of you, and thanks for your interest in Teva. I'll start by the financial highlights. Our revenues came in at 3.9 billion, which is roughly the same as a year ago, and it was really driven very much by Ajovy and Austedo, and it was also affected by the continued slightly lower script volume due to COVID-19 restrictions in Europe, in generics and OTC, and to some extent also lower total market in the segments where Ajovy and Austedo competes. So overall, given this situation, we were very satisfied with the revenue as they came in. The adjusted EBITDA came in at 1.2 billion, and the GAAP diluted EPS came in at 19 cents, and the non-GAAP diluted EPS at 59 cents, very much in line with our expectations and the consensus estimate. The free cash flow came in at 625 million, also a number we were satisfied with. Our debt reduction continues, as we've laid it out several years ago, according to our plan, and the net debt to EBITDA ratio is now down to 4.7. The 2021 revenue outlook is lower to reflect the ongoing impact of COVID-19 from 16.4 to 16.8 billion down to 16 to 16.4 billion. However, operating income, EBITDA, EPS, and free cash flow remains as already guided, so it's reaffirmed. And the reason for this is basically that we have been awaiting the consequences of COVID in the total market, and therefore we've been cautious since the beginning of the year, of course, on our spend. And now we can see that we have had a relative to our plans negative effect of COVID-19 on total market volumes in the first and second quarter. Nothing to do with the market share of our products, but basically just a phenomenon of patients not going as much to the doctor and the hospital as we expected in the first and second quarter. We do expect this to change. We can see it's changing in the US due to the lifting of sanctions, and we can also see the first signs it's changing in Europe due to the lifting of sanctions within the last 1 or 2 months. If we go to the next slide, then you see the revenue development here from 19, 20, and 21. And you can see we have a very stable situation, just around the 4 billion per quarter, a little up, a little down, depending on launches. And of course, longer term, we want to change this into a growing trend. But it's really still the dynamics between the nice growth we have on Austedo and Ajovy and the continued decline we have on Copaxone. Copaxone this year, as you have seen, will be down to around 1 billion. And that really means that the drag from Copaxone is, of course, getting less and less by the year, and next year it will be hopefully minimal, and that means that next year with the growth of Austedo and Ajovy, we will see a more positive picture. Next slide, please. Austedo continues to grow, and you can see here the script numbers, the total script numbers per quarter, where we had a new all-time high here in the second quarter. You can also see the revenues per quarter, and they're a little up and down, and there's some true-ups of rebates in there sometimes. There's some wholesaler swings in there sometimes. There's been a little bit of a, as you would say, lower wholesaler purchasing in the first quarter, which is corrected in the second quarter. Underlying, we see a strong trend of growth aligned with the TRXs. We see a stable pricing, and we are, you could say, starting a new initiative, which we started in May, which is a DTC campaign targeted at, you could say, tardive dyskinesia. And tardive dyskinesia is, of course, a huge unmet need in the United States. We estimate there's around 500,000 people suffering from it, and only a fraction is treated so far. The campaign so far has resulted in expanded activity on our websites, and we are optimistic that this will continue to drive growth in prescriptions and consequently also continued growth in sales. As a consequence of the slower market development compared to what we expected, we have lowered the outlook for Austedo for the full year from 950 million down to 850 million. Next slide, please. Ajovy shows solid net sales growth in the second quarter of 21, and it's really based on both the US and the European performance. As you see here to the left, the US performance in terms of TRX is showing a very steady growth. It's increasing steadily quarter over quarter, and we saw record high sales in North America. The same thing is the case in Europe, where you can also see, here we show the market share, and you can see how the share has gone from around 10% now up to around 25% in a couple of years, and we expect this to continue to grow. And as I said, the last quarter we have changed our ambition level. We are now having an ambition level both in the US and in Europe of a third of the market, so a market share of 33%. And we think this is doable within the coming years based on the very, very good safety and efficacy profile of Ajovy and the fact that it is the longest acting product and therefore also the only product that can be dosed both monthly and quarterly. So we are very optimistic about the future growth of Ajovy. If we go to the next slide, then it shows Truxima, our biosimilar, and it shows how it continues to grow in share in the market. Right now we also hear around 25%. And the market has been improving after a sort of overall market slowdown in the first quarter, probably related to COVID, has started to improve, and we expect it to continue to improve in total development over the year. And of course, Truxima is the only biosimilar rituximab which has the RA indication, and as such very competitive, and we believe we can hold on to a strong share in this, our first major biosimilar launch. If we go to the next slide. As you know, our financial long-term ambition is really to secure a business with a good operating margin, with a good cash conversion, and with an ever-decreasing debt in order to basically stabilize the financial situation for the company. And I can say when it comes to the operating margin, we are well underway. Since it bottomed out in 2019, we have been improving it significantly. And right now we are just shy of 27%, which is the target for this year. And of course, we're aiming for the 28% in 2023. And we are very confident that we can meet this target for the operating margin. Go to the next slide, please. I was just talking about our long-term financial targets. They are unchanged, and of course, they're to be achieved by the end of 2023. And I just mentioned the operating income margin of 28%. Cash earnings, we want that to be above 80%, and then we want the net debt to EBITDA ratio that's currently standing at 4.7 to come down below 3. Now, when we execute our business, we deliver more pharmaceutical products, more medicines to the world than any other pharma company. And that's, of course, very, very important for the patients who use the products every day. They get high-quality medication that serves them well in treating the condition they have. But there's also another aspect to what we do when we are the leading generic company in the world, and that is that we help to create sustainable healthcare systems where the authorities or insurance companies or whoever pays for the medication, the private individual, get a chance to have a sustainable and affordable access to medicine. And we've started 2 years ago to have an independent external company do a report on what is the real economic benefit of our activities. And I'm just going to show you a few snapshots here. The report is available. You can find it online. It's from Matrix Global Advisors. And here you can just see some highlights that we saved the U.S. healthcare system some $29 billion in 2020. And you can see we've done it by state. We have the details by state in the report. But you can also see that the savings, they ended up, some of them with the government, some of them with private healthcare insurers, and some of it out-of-pocket co-pays that got reduced and so on. And just the saving directed to the patients were $4 billion. So a significant contribution to the U.S. healthcare system. Now, the same can be said for all countries where we operate. We don't do the report on all countries. That would be a very, very big task. But we did do it for 9 countries in Europe. And also here you can see the same pattern that we have been saving the countries a lot of money. And on top of this, of course, when we do generics and biosimilars, we also create a lot of economic activity, which basically means that we contribute to society, not only in the form of savings in the healthcare system, but also in the form of job creation, in the form of economic growth and support to GDP in the various countries. So this was just a little teaser. If you're more interested in this, take a look at the report. You can find it online. But with this, I think we should move on to have a look at the financials. So I'll hand over to our CFO, Eli Kalif.
Thank you, Kåre, and good morning and afternoon to everyone. I begin my review of the second quarter 2021 financial results on slide 14, starting with our GAAP performance. Revenue in the second quarter of 2021 were approximately $3.9 billion, an increase of 1% or a decrease of 2% in local currency terms, compared to the second quarter of 2020. This decrease was mainly due to a low revenue in our North America segment, mainly related to Copaxone and ANDA, partially offset by positive foreign currency impact, as well as higher revenue from generic products, OTC, Ajovy, and Copaxone in our Europe segment. Revenue were also affected by changes in demand for certain products resulting from the impact of COVID-19 pandemic. Our Q2 2020 included generic product sales in Japan totaling $65 million and approximately $240 million for the full year of 2020. As we have previously communicated, these products were divested as of February 1st, 2021, along with a manufacturing site in Japan. Exchange rate movements during the second quarter of 2021, including hedging effects, positively impacted revenue by $135 million compared to the second quarter of 2020. In Q2 2021, we recorded a GAAP operating income of $582 million versus $173 million in Q2 2020, GAAP net income of $207 million versus $140 million in Q2 2020, and a GAAP earning per share of 19 cents versus 13 cents in the same period a year ago. The year-over-year improvement in GAAP operating income, net income, and earning per share was mainly due to a lower other asset impairment, restructuring, and other item charges, and higher profit in our Europe segment, partially offset by higher intangible assets impairment charges. Turning to slide 15. You can see that the net non-GAAP adjustment in the second quarter of 2021 were $444 million versus $465 million in the second quarter of 2020. Non-GAAP net income and non-GAAP earning per share for the second quarter of 2021 were adjusted to exclude these items, with the largest being impairment of assets totaling $226 million in the second quarter of 2021. This includes an expenses of $195 million for identifiable intangible assets impairments compared to expenses of $420 million in the second quarter of 2020. Amortization of purchased intangible assets totaled $173 million, the majority of which is included in cost of goods sold. Now moving to slide 16. We review our non-GAAP performance. Kåre and I have already reviewed the second quarter revenue, which totaled approximately $3.9 billion. So let's move down to the P&L and look at the margins. A year-over-year total non-GAAP gross profit increased by 4%, and our gross profit margin improved to 53.3% compared to 52% in the second quarter of 2020. The year-over-year increase in the non-GAAP gross profit margin was mainly driven by higher profitability in Europe and international markets resulting from the change in product portfolio mix, as well as the network optimization activities, partially offset by lower profitability from Copaxone. Our non-GAAP operating margin was 26.4% versus 25.3% a year ago. The increase was driven by the higher gross profit margin mentioned above. We ended the quarter with a non-GAAP earning per share of 59 cents, compared to 55 cents in Q2 2020, mostly due to the higher gross profit. Now let's take a brief look at our spend base on slide 17. Year-over-year, our quarterly spend base declined by approximately 15 million, or 120 million net of FX. However, looking at our year-to-date comparison, spend base declined by more than 200 million, or more than 400 million net of FX. The main driver for this change was a reduction in our cost of goods sold, as operating expenses were slightly up. The decline in sales had the greatest impact on the reduced cost of goods sold, supported partially by our ongoing efforts to improve our gross margin through the transformation of our network. Based on the first 6 months of 2021, and according to our current estimation, we believe our spend base will come in approximately 12 billion for 2021. Now turning to free cash flow on slide 18. Teva's free cash flow in the second quarter of 2021 was 625 million, a nice rebound from the 59 million generated in the first quarter. As we have noted before, Teva's free cash flow typically faces a few headwinds at the start of the year due to usual timing of annual merit payments paid out in the first quarter. But the headwind was especially large in the first quarter, mainly due to a timing of working capital items resulting from the increase in the net accounts receivable and inventories, as well as lower profit in our Europe segment. Please recall our 2021 free cash flow guidance, which we first provided in February, reaffirmed in April, and are reaffirming today. 2021 free cash flow is expected to be in the range of 2 billion to 2.3 billion. We expect this free cash flow to pick up during the next 2 quarters as we keep driving optimization of our working capital with a high focus on inventory improvements. Turning to our outstanding debt on slide 19. Net debt declined to 22.7 billion versus 23.7 billion at the end of 2020. I'm pleased to report that just last week we repaid an additional 1.5 billion, which is not reflected in the quarter-end totals. Additional upcoming maturities, including 1.2 billion in the fourth quarter. Our net debt to EBITDA continued to decline, coming in at 4.7 for Q2 2021. Debt reduction continued to be our primary focus and main use of cash as we continue to push forward in our efforts to bring our net debt to EBITDA ratio under 3 times by the end of 2023. So turning to the financial outlook for 2021 on slide 20. While we have experienced a nice recovery in some countries and products from the effects of the global pandemic, we unfortunately have not seen this everywhere in our business. Some markets and products are still feeling the lingering effects that the pandemic has had on the purchasing pattern of our large global customers and overall utilization by patients. Based on the results of the first 6 months for 2021, we believe at this time it is prudent to adjust our guidance range for full-year revenue from the original range of 16.4 billion to 16.8 billion to the new range of 16 billion to 16.4 billion. This lowers the midpoint of our range by 400 million. The new range includes an adjustment to our full-year expectation for global sales of Austedo, for which we are lowering our guidance by 100 million to 850 million for the reason Kåre mentioned earlier. For our other financial targets for 2021, operating income, EBITDA, earnings per share, and a free cash flow, we are reaffirming the current ranges first provided in February, reaffirmed in April. We will end up with each of these range. We will be determined mainly by the rate of the recovery in the purchasing pattern and overall utilization by patients, as well as our product mix in our generic business for the rest of the year. And this concludes my review of the results for the second quarter and 2021 financial guidance. We'll now open the call for questions and answers. Operator, would you please open the call for questions?
Thank you. As a reminder, to ask a question, you need to press star and 1 on your telephone. To present everyone with the opportunity to ask a question, please limit yourself to 1 question only with 1 follow-up question. To withdraw your question, please press the hash or pound key. Please stand by while we compile the Q&A roster. And your first question is from the line of Gary Nachman from BMO Capital Markets. Please go ahead.
Hi, good morning, guys. With the lowered revenue guidance, could you elaborate on what you're doing to maintain EBITDA, EBS, and free cash flow guidance a little bit more? How much is gross margin improvement versus reducing OpEx? And are you likely to be at the lower end of the ranges for EBITDA, EBS, and free cash flow? And then, also just how do you see the second half recovery from COVID? How do you see that playing out? What's built into the guidance if the first half arguably saw maybe a little bit more pressure than what you had anticipated, and maybe talk about